bring in the head of global strategy at Standard Life Investments, Andrew Milligan, joining us on the phone right now from Edinburgh, Scotland. And Andrew, you know, Sarah just laid it out pretty nicely for us, but with these bond auctions and these yields going back up, is it just these concerns about more bailouts, about small sovereigns and various local locales, or what? What exactly is behind this?
I think we've got to realise that the European sovereign debt issue is one that's going to be with us for a number of years, and periodically during that period, time, investors are going to get worried. Each quarter, Greece has got to come along and reassure the IMF and the European Union that it's on its budget path, and this is one of those periods of tension. I'm not particularly surprised. We certainly are seeing higher spreads, but I would put that into context. For example, Italy is still paying less than 4% for its 10-year bonds, which on any historical basis is still very manageable indeed. So the spreads are wide, but that is in the context of the extremely low levels being seen in some countries such as Germany and America.
So where does that leave then investors, Andrew?
I think that leaves investors, as ever, with some difficult decisions to take about which markets to invest in and the timescales they're trying to invest over. Undoubtedly, a number of bond markets are very well placed at the moment, and any investor in the US bond market has done well this year. But when do you jump out because an eventual response to the sovereign debt crisis, either in Europe or even, heaven forbid, that somebody begins to think about the debt problems facing the United States? Do we see central banks actually adopt far more quantitative easing? Does that lead to inflationary fears, and suddenly we enter a position where bond markets sell off quite noticeably around the world? That's the big debate which a number of investors on both sides of the Atlantic have had for some time, and the jury, of course, is out and will remain out for some years still to come.
No, I think you outlined that very well, Andrew. Just quickly, though, okay, from where it leaves investors, but then where does that leave the ECB then?
I think the European Central Bank will be very reassured by the growth figures that came out this morning. Admittedly, a large part of it was due to the trade surge being seen in Germany, but we shouldn't forget that other parts of Europe also grew well. I think, therefore, they'll be watching and waiting. We expect some slowdown in European activity into the second half of this year, but the ECB really doesn't want to take any decisive action for some time to come. It's watch and wait mode.
Okay. Andrew, thank you so much. Really appreciate you joining us. Andrew Milligan, the head of global strategy at Standard Life Investments.